America's mid-term elections on Tuesday the 8th of November are likely to generate plenty of headlines, but you may be pleased to know that the week ahead could be a fairly quiet one when it comes to macroeconomics. The most important data point is also likely to come from the other side of the Atlantic in the form of the latest American inflation figures. They are due for release on Thursday the 10th. The US Federal Reserve made its latest monetary policy decision on November the 2nd, but the US Central Bank has December's meeting to come and then, as usual, 8 more next year. And right now, the Fed is failing in one half of its mandate, which is to keep inflation around 2%. The last print in September was an 8.2% year-on-year increase in the Consumer Price Index, and that's our benchmark for the October reading. Economists, politicians, consumers and central bankers will no doubt all be hoping that inflation is starting to peak out, and financial markets, judging by October's rally, are starting to think in terms of a central bank pause or pivot in monetary policy, whereby the run of interest rate hikes comes to an end and cuts become the order of the day once more. We shall see. But do remember that the last time US inflation reached 8.2% was January 1982, and the Fed funds rate then was 14%, way, way, way higher than where we are today. In terms of corporate news, it could be another busy week, since nearly 1/5 of the FTSE 100's members are due to release results, issue a trading statement or host an analyst meeting. Mid and small cap companies have a lengthy scheduled list of announcements too, and names which may be worthy of further research include the following, although do please bear in mind some of these dates could yet be subject to change. Beazley, Ryanair and Kingspan on Monday the 7th of November. DCC, Aveva, Coca-Cola HBC, IMI, Persimmon, Direct Line and Oxford Instruments on the 8th. Aviva, Taylor Wimpey, Smiths Group, Flutter Entertainment, ITV, Marks & Spencer, Watches of Switzerland and Volex on the 9th. AstraZeneca, National Grid, Haleon, B&M European Value Retail, Convatec, 3i, Auto Trader, Endeavour Mining, Vistry and WH Smith on the 10th. And then deep breath, Redrow and Young's Brewery on Friday the 11th. But the company which could just cause the biggest fuss in the week ahead is Associated British Foods. The owner of Primark, British Sugar and Twinings Tea is due to report full-year results to the end of September on Tuesday the 8th of November. As is the case with a lot of retail-related stocks, shares in AB Foods are down by a quarter over the past year, and actually they're down by 60% from their all-time high, which in AB Foods' case was actually reached way back in late 2015. One reason the shares are down in the dumps this year at least is early September's fourth quarter trading statement. AB Foods noted it would meet expectations for the year to September 22, but it then steered down analysts' forecasts for fiscal 2023 in what was effectively a profit warning. As a result, management now expects sales to be up strongly in 2022 and up again in 2023. Adjusted operating profit and adjusted earnings per share to rise strongly in 2022, but adjusted operating profit and adjusted earnings per share to fall in 2023. Rising input cost pressures, fractured supply chains, energy bills, sagging consumer confidence, investment in new floor space and investment in the online proposition at Primark are all reasons for the profit shortfall, and also the company's made a conscious decision not to push up prices too much at its retail business, and all of those underpin the downbeat forecast for the new financial year. So when we look at the numbers in terms of the headlines, sales are expected to come in about 20% higher at £16.7 billion for the year to September 2022, before advancing 9% to £18.4 billion in the new financial year. Earnings per share are expected to reach 122p against 61p on a stated basis, and on an adjusted basis, substantially exceed last year's 80.1 pence before the expected dip in fiscal 2023. The dividend per share is expected to reach 47 pence in total. Note that management may also unveil plans for an additional distribution of what it calls surplus cash. AB Foods did offer a special dividend of 13.8 pence a share in fiscal 2021 on top of regular dividends that were worth 26.7p a share. Analysts will then dig into the divisional trends by sales, profit and profit margin at grocery, sugar, ingredients and retail, with retail the area likely to attract most attention. In September's update, AB Foods flagged that Primark's operating margin would come in at around 9.6% for the year just ended, but having slid to 8% in the second half from 11.6% in the first. Management then said it would come in lower again for the whole year in 2023. Primark still expects to increase its revenues in 2023, thanks to new store openings and also price increases. Unfavourable currency movements are a further complication as Primark buys mainly in dollars and the greenback's rampant against the pound. Again, however, management doesn't want to push prices too far to help maintain Primark's value credentials for its customers. As a final point, watch out for an update on the click and collect trial that's due to begin at Primark in the UK in the fourth quarter of this calendar year, the first quarter of the company's new fiscal year. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.